The short squeeze before it all comes down in flames. Hey, everybody, you're watching Bull, Boom, Bear Bust, back with another dose of economic reality. My name is JJ. Please make sure you hit that like button and get this video some traction. We really appreciate it. Let's go ahead and get into it right now. Last week, the stock market went crazy, went ballistic. I mean, not completely crazy, but pretty crazy considering all the risks out there globally right now. Stocks had the best week in a year last week. Now, typically, what happens before a big downturn is a pretty big rise, and typically that's a short squeeze. And you have a lot of big money out there, a lot of institutional money that like to push people out of their trades, out of their short positions in order to capitalize on it, even to an even bigger degree, right? So if you're shorting the market and you see the market go up, and unless you have a lot of money or unless you're just making a small investment or a small portion of your portfolio, you're likely to get out of that trade because you're underwater. If you're shorting the market, you're underwater. So a lot of people probably did exit the market that were shorting, but the big institutional investors, remember, they're the ones that push the markets up and down. It's not the little mom and pop investor or even the individual investor on Robinhood or E-Trade. It's the big institutions, the hedge funds, the big money, right? We know, and I shouldn't say we because not everybody may know, but people that watch this channel probably should know because I like to remind you every few weeks that 90% of stocks, close to 90%, the last time I checked it was 88%. Close to 90% of all stocks are owned by the top 10%. We're talking about the mega rich here. So yes, they have the leverage, they have the ability to move the markets up and down. And if they see a lot of smaller investors shorting the market, what do they like to do? They like to push them out of the market by short squeezing and pushing stocks up. And typically, if we look at downturns, previous downturns, we see right at the very end before the drop a big surge upward. And if you look at a lot of different markets where corrections have happened or even busts, like the housing bubble, we saw home prices go ballistic in the last year, 2008, before the final, I shouldn't say a crash, because now looking back, it really wasn't a crash. Back then, it seemed like a crash. But before the downturn, we saw a pretty big squeeze upward and some pretty high percentage gains. Now, the stock market, anything could happen. I mean, we could hear rate cuts, a rate cut announcement come out next month, and the markets will shoot up like you've never seen before because this whole thing is based on easy money. Now, when it comes to easy money, there's a lot of institutions out there that have access to billions of dollars at the click of a mouse. And if you're a small time investor or even a middle class investor, you're going to have a very difficult time trading against this type of money. So my trades that I do are pretty long term. I don't do short term trades anymore. For example, back in 2020, I got into some oil stocks, and even to this day, I still hold some shares of ExxonMobil. I got rid of probably 80% of my shares, but I'm still holding some because if we see a major disruption in oil and gas manufacturing, the supply, especially with all the wars breaking out right now, you could see a big spike in oil prices, right? So I'm still holding some for that inevitable, or I shouldn't say inevitable, for that possible spike up in oil prices. I hope it doesn't happen actually, but at least I'll make a little bit of money on it if it does happen. But the extra money I'll be spending over here in the gas tank versus what I make in the stock probably is I'll be worse off if there's a spike, but at least I'll have a little bit of a gain out of it, better than completely not having any position. But my point is, if you're trying to trade short term in this, if you see stocks going up and you're trying to jump into the rally, I would just say be very, very careful. Yes, anything could happen. And who would have thought that last week you would have witnessed the best week in over a year with all the issues happening right now globally. And speaking of that, before we get back into the markets here and other stories here I want to get into, financial news, let's get into just some real quick headlines here on what's happening globally in these conflicts. We have escalating U.S. involvement right now. Militia attacks are escalating on American troops that risk Washington Tehran confrontation. Russia expanding military in Libya. Pro-Palestine protesters worldwide call for Israel's elimination. Marchers descend on the White House, chanting Allah Akbar. Israel shooting down ballistic missiles. I was seeing a lot of different people just arguing back and forth, taking sides. And there's only, in my opinion, there's only worse to come here as far as these global conflicts. Now, how much of this is financial? Well, I think a lot of it is. And also, when you look at the stock market gains that we just talked about a few minutes ago, when we see war breakout, you see a lot of defense stocks start to spike because war is big money for some people and for some companies. And when you look at the size of some of these defense companies, defense contractors, you can see how they would really easily move the markets. And there's a lot of people that got in very early on this. You have to wonder, who knew what ahead of time. But we always kind of see this around the time of global conflicts as we see these defense stocks really start to go up. So I would like to know where you're positioned at right now. I think cash is a really good place to be right now with the returns you're going to get. You could sit in a money market and get around 5%. You could even get a CD. I believe I saw a 9-month CD for close to 6% right now. I don't like to keep my money tied up, not even for 9 months. So I kind of stick with liquid money markets when it comes to cash. So it's getting to the point where 5% is starting to become kind of attractive when inflation is not as bad as it was. Inflation is still a problem. Let's talk about the US dollar and de-dollarization here globally happening. Is the dollar crashing and burning? Absolutely not. It's actually down a little bit for the year here. So for the year, we're down 7%. I shouldn't say a little bit. It's kind of a lot. It recently came down, though. We were up at about, this was early October, and this is the US dollar index, which is comparing the US dollar to a basket of other currencies, which are also fiat currencies. But we were up to 107 in early October. We're down just under 105 right now. And this puts the dollar, or compares the dollar to a few other currencies here: the euro, the Japanese yen, the British pound, the Canadian dollar, Sweden's dollar, and also the Swiss franc. So let's keep an eye on this here. And if rates remain high or move higher, the dollar could likely remain very strong for the time being. So anyone exiting their dollars into stocks right now or other assets, real estate, what have you, I would urge some caution. I would urge caution right now. And to me, the risk has never been higher, especially what we're seeing here globally. You look at the levels of debt here in the U.S. with U.S. consumers. I just read another statistic here earlier that U.S. automobile loan debt is twice as high as it was now back in 2008 before the financial crisis ensued, the GFC, the Great Financial Crisis. It was about $0.8 billion or 800 million back then. Now we're just under $1.6 billion. So something else to really think about when you're looking at the stock market and how last week was such a real good week for the market. Just keep an eye on the big picture is what I would urge, because I don't want to see anyone here get burned, right? We got to be smart about what's going on right now. I know it's impulsive, and impulsive people want to jump into the market when they see something running in price. They want to jump in. I think the same thing about silver. Don't jump in when it's running up like a lot of people did. I like to accumulate when it's low, and it's actually not too low right now. It's hovering at about $23. But I did accumulate a lot back at $16, $17, $18 per ounce. And I'm waiting for that to go up. And just like everyone, you get into something, you want it to go up. And, you don't want to sell, and you don't want to panic out of a stock unless it's already taken at least a pretty decent increase, in my opinion. So we're all waiting for the day for especially silver to skyrocket and actually make some sense as far as the price. When you look back at the 1980s, silver was close to $50. And that was a pretty amazing time. But I would have been a seller back then. And, just have to pick your time to buy and sell. All right, but let's get into some other news here. Now let's talk about the drastic increase in theft and crime especially in the bigger cities. Let's talk about San Francisco here real quick. We've got a McDonald's that's been open for 30 years, shutting down in San Francisco. And there was a segment recently out of CNN in a San Francisco Walgreens. There were 3 thefts within 30 minutes. And this is a Walgreens that's locking up coffee now, and even drinks, locking them up. Like, you just go to a drink at most stores and open up the cooler. At this particular location, you've got to call an employee over there to get a drink out of the cooler. Pretty amazing here. But this was all expected. And, until the cost of living starts coming down, this is going to get worse. And these cities, you have to wonder why companies would want to be in big cities right now. There's just a big expansion that Google was going to do in the Bay Area, and they just put a halt on that. And you have to wonder, what companies are going to do when the cities get even worse. And we think that the crime wave, the homelessness, the poverty because of the cost of living is just going to continue to get worse. We've got reports now coming out of New York City that Central Park is going to be filled up with tents and shelters now for homeless people there. So, wow, this is getting crazy, even for people with a good amount of money. It's been like that here in California, where people on the beach, especially Venice Beach up by LA, you look out the window in $1 million mansion, probably $3 million mansion now with the cost of homes. You look out the window and you've got tents right outside your window, even though you're a millionaire. Now, New York Central Park, it's going to be the same thing. A lot of big money around that area. New York City, you're going to look out and you're going to see tents decorating Central Park. Now, I wanted to give you a little bit of an update on the latest bank failure. This was this bank out of Iowa, and Citizens Bank. They're saying that this was tied to bad trucking loans. Bad trucking loans. If we warned here that the trucking industry is not looking very good, when you look at the cost of transportation, when you look at the wages that the drivers are demanding right now for the cost of living or to keep up with the cost of living, a lot of trucking companies already have failed, and it's likely to get worse. But let that paint a picture, though, about where we're at in the banking industry in general. So we have banks that gave out these loans to trucking companies, business loans, and look what happened. And you look around now, and banks everywhere are pretty much in the same position. They've loaned out money to consumers. And is the consumer going to become stronger or weaker over the next year? Well, it's going to be weaker because the cost of living is going up. Inflation's not coming down. Wages not keeping up with inflation. Debt is rising like we've never seen before. Now, that can't last forever. The U.S. consumer can't take on endless amounts of debt like the U.S. government can. So there's going to be a reckoning day, and there's already beginning to be a reckoning day. When you look at foreclosures, are up about 28% year over year. Bankruptcies are up between 10 and 20%. I've got to get the latest numbers, but the last numbers I have, it's closer to 20%. And we're still waiting for the third quarter numbers to come out on that, by the way. Everywhere you look, debt, we talked about debt earlier. Car loan debt, twice as bad as 2008. Credit card debt, $1 trillion and getting worse, still going up. So everywhere you look, things are getting worse. So why would banks still be giving out loans right now in this environment? Well, as soon as the money stops, as soon as the loans stop, then the economy begins to crash, because a lot of the economic activity and purchases that we're seeing right now are based on loans, taking on debt, and borrowed money. So this is basically the definition of a Ponzi scheme. You always have to have new money coming in to keep the scheme propped up or to keep it going. And as soon as that new money comes in this case via debt and people borrowing money, spending money on the credit cards, then the whole thing comes crashing down. So of course, the last thing they want to do is shut off the money spigot right now. That's why we have this continuing bank bailout program happening, what they're called the emergency lending program. And even with that, though, they're allowing some of these small banks to fail, but they've got to keep the money flowing. So this is going to continue. So you want to ask yourself, things likely to get better or worse. Now let's talk about this article that I saw here earlier. Self-storage units, the prices have gone crazy in some areas. Here's an article here out of Ohio, how a storage unit went from $130 to $235 a month in less than a year. And when I look at the people that are using storage units, a lot of times they're paying more than the items in the storage unit are actually worth. So if you look at a year, even if it's $130 a month over a year, you're talking about $1,500 a year, right? About $1,560. And when you add up the worth, not what you paid for, but what it's worth right now for all of your used items, for all of your stuff, a lot of times when you add that up, you're paying more per year in costs to keep it in a storage unit versus what it's actually worth, what you could sell it for, maybe what you could buy it for in used condition. But I don't think people factor that in. People often look at what it would cost to buy their items in brand new condition, which they would be a lot more. But when you look at what the stuff's worth in used condition, it's usually not worth what you're paying for it in storage. But yet people are still paying these prices. And back to this story right here. This is out of WCPO. After appealing the sharp rate hike, he said the manager agreed to drop the price a bit. It makes you wonder why you can negotiate certain prices, but not others. Can you imagine going to the grocery store, getting up to the checkout counter and saying, hey, let me negotiate the price of this milk here. It shouldn't be $5, and trying to negotiate the price. That wouldn't go so well, would it? But certain industries, obviously, they'll come down on their rates. Any sort of rental, even as a renter, you can usually negotiate with your landlord in some markets. Now, when the market's really tight and when rents are going up, you're less likely to be able to talk your landlord into a better deal. But when the market's weak, might be a good idea to try to negotiate a better rate. We are starting to see rents come down as well. That's another sign of consumer weakness. Is rents are falling, and then we actually saw rents fall for 5 months in a row now. Another indication that the consumer's cash flow is starting to dry up. And there's another stat out there that I just read earlier. Let me bring this up here. And this is the U.S. consumer savings rate. And we're seeing the savings rate go back down. And the official name of this is the consumer savings rate. Now, earlier this year, February, March, April, May, we saw the savings rate increase because at the end of 2022, it dropped to 3.5%. And this is the percentage of the average U.S. household's disposable income that they have left over after paying their monthly expenses. It got down to 3.2% at the end of 2022. We jumped up here. April, May, it was a high of 5.3%. That was still low, but 5.3%. And now we drop back down to 3.4%. So this is another sign, folks, that the U.S. consumer is in a pretty tight spot right now. And the U.S. consumer is the driver of the economy. So just take this and use it in your plans. And, hopefully this will help us kind of get a better vision on what we want to do, where we want to be positioned as things continue to deteriorate. And also back to the beginning of this video regarding the stock market. Do you think this is a short squeeze before the panic starts to really hit in the stock market and we see even big money start selling off stocks? I think that's a very likely scenario. We also see Warren Buffett out there sitting on another record pile of cash. We've seen this happen a few times over the past few years where he gets these big cash positions, but now it's being reported he's on another record pile of cash. And what does big money like to do before a big market downturn is they like to have a lot of cash. That way they can come in and scoop up assets, stocks, you name it, for pennies on the dollar. So could that be another sign? You let me know down in comments. Like to hear from you. Thanks everybody for watching. We're going to wrap this up. Keep stacking, everybody. Until next time, hope you're well. Hang in there. Peace.